In this video, I'm going to let you peek inside the corporate structure of my indie film studio, Exile Entertainment, so that you can understand how to set up your own indie film studio, whether that's now or sometime in the future. And make sure you stick around until the end of the video because I'm going to give you the 3 mistakes that I learned along the way and how I would do things differently if I was starting again today. Quick disclaimer that this is not financial or legal advice. Everyone has different circumstances, so I recommend that you consult with a lawyer or accountant or a financial advisor before you go and set up your own corporate structure. All right, so let's dive in here. What I've got on the left is the corporate structure for Exile Entertainment, and on the right, I've got my suggested structure for how I think you should set things up, but we'll come back to that. For now, let's focus on Exile, and let's give you a look at how things are set up for me currently, and how we got to this point. Probably a good place to start is right here in the middle. This company, Exile Productions, is really the main company that I use to finance and produce feature films. So this company right here acts as a holding company and a trading company. So when I say a holding company, the reason I'm using that terminology is that it owns and holds the IP of all of the films that we've made. So that IP sits in this company right here. And so when we're receiving royalties from those films, those royalties are coming into this company as the owner of the IP. Also worth noting that when we're developing IP, so when we're in those early stages of development, either when we're looking at optioning a book or maybe we're co-producing a film with someone, again, those rights will sit in this vehicle. Now, this vehicle here, the reason it's also a trading company of sorts is that it's also the place that the fees that we charge as producers are paid to. So any fees that we charge on a production, whether it's in development or during the production of the film, those fees all come in here. So it's owning the IP and it's charging me out as a producer, and those fees are coming into that company. Also, any overheads that the holding company is charging a specific film, which it can do, those overheads are coming into this company right here. So this is, you could think of this as like a parent company, or a holding company is probably the best way to think of it, because it holds the IP of the film. And then its trading activities is pretty minimal because really its core activity is to charge out producers for them to charge fees on a project. So, overheads are low. We have, very minimal kind of operating expenses each month. There's like rent, some basic software, any wages, and that's about it, right? So it's a pretty low risk company. And so that's why the IP and those fees are all sitting in the one company. Another way that you could do this is actually to split it out further. So to have 2 companies here where one just owns the IP and it doesn't have any money coming into it. And then the other company is the one that has the money kind of flowing in and out. Now, as you're going to see, these structures can become very complex very quickly. So at this stage, it's not something that I think is necessary. I think it's okay having them all in one because, again, there's not much activity in terms of trading going through that company. So the risk is quite low to it. And so I don't, my personal view on it is that I don't think that the IP that's held in that company is really, at any significant risk. If we got to a point where there was lots of trading, we had lots of employers, maybe there was some other activity going on in there, we might think about splitting it out. But for now, this works just fine. And really one of the themes for me in the last 2 years has just been like, how do I simplify this corporate structure? I'm going to take you through how I'm doing that at the moment. So that's really the starting point, and that was the first company that I set up. So I set this company up after I'd made my first film. So I made one feature film, with an SPV. I'm going to take you through what that is shortly. And then after that was made, I set up this company, and then that company has become the kind of main holding company for Exile. So let's go over to the left for a moment. So this company, Exile Productions, needs to have shareholders and it needs to have directors. So I'm the sole director of the company at the moment and the sole shareholder through an entity called Exile Entertainment, which is a trust. So I could own the shares in this company as an individual, through a company, or through a trust. And really choosing which of those it should be is something that you should get advice on. And so, I've set it up as a trust just based on advice that I received from lawyers and accountants. Basically, there are some tax benefits to doing it this way. And so that's how I've set it up. So the shares in Exile Productions are owned by a trust. Now, this trust also owns shares in Exile Distribution and Exile Consulting. So I'll take you through what those are now. So Exile Distribution, as the name suggests, is a distribution company. So it basically licenses rights to films and then takes those rights and then exploits them. So, it puts films in cinemas, it sells them to TV stations, to streaming platforms, used to put them on DVD, those sorts of activities. So it would license films made by Exile Productions, so the IP would go from Exile Productions into Exile Distribution, and it would then release those films, and then revenue would flow back through Exile Distributions into Exile Productions, and then it would also license and release films from other producers, other production companies from different parts of the world, and it would release them in Australia. So that's what that company was set up to do. Its shareholder is Exile Entertainment, not Exile Productions. And the benefit really of having that company was twofold. Like, number one, it was a way initially for me to be generating cash flow. So, production company is very lumpy in terms of the revenue, in terms of the income. Distribution is like high cash flow. You can be really having like monthly, weekly cash flow coming in and out. So it was a good initial way, I thought, to kind of complement the production income. But for some reasons, which I'll mention at the end of this video, I would probably do things differently if I set it up again. And there were some benefits as well, particularly in Australia, where our tax incentives are tied to distribution. And so as a producer having a distribution company, it's quite beneficial because then it can help you finance your own productions. Now, this company up here, Exile Consulting, is one that I started about a year ago, just over a year ago. And that started when I launched our mentorship program, the Producing Accelerator. If you don't know what that is, just click the link onto our website in my YouTube channel, and it'll take you there. You'll be able to find out more. Basically what we did here is we set up a separate entity for that business to run. But what I found as I started going was that ultimately a lot of the expenses and even the people were quite shared between the production company and the consulting company. And so ultimately I decided to shut this company down. So this most recent financial year, this company has now been shut down. So we can remove that. And that's kind of simplified my structure a little bit here. And then what may happen is we may end up ultimately shutting down the distribution company. We're not sure yet. We have a few films that we're going to release in the next year. But, a big focus for me and for the company at the moment is really production and financing. And so having the distribution company may just make less sense in the future. For now, it's still part of the picture. And so this is really what the structure looks like. And so on the right here, what we have is for each film that is produced, we set up a new company. So this company is called an SPV, which is short for Special Purpose Vehicle, which means really that it's been set up specifically for the purpose of making a film. right? It wouldn't exist otherwise. That is its sole purpose. And once the film's made and finished, this company actually gets closed. It gets wound up, deregistered. So the way that this works is so let's say we have film one, it's a new film, the finance has been raised, all the contracts are with this company, with the financiers, because it's the owner of the IP. But then this company here, the holding company, we'll set up the SPV, and then this company will hire the SPV to actually make the film. So it will advance the money to it, and then the SPV is the one that's responsible for the trading, right? For actually the trading activity of the film. So it will hire everyone, it will contract with everyone, the insurance will be under here, and it is responsible for everything, the payroll, right? And so the reason that we do it in this way is because really two reasons. Number one, we wanted to, capture the liability of the film in this company here, in the SPV, and have that separate from the holding company. And the second reason is that in Australia, due to the tax incentives that we have, it is just recommended by our accountants, our advisors, that we set it up in this way. It's kind of the done way to do it, and it really just makes it a lot cleaner when it comes to tax. When you're basically getting the tax incentive back from the film commission, it's much cleaner if everything's just sitting in one company, and that company isn't doing all sorts of different projects and different activity. Everything's just in that one vehicle. Just makes it very clean and easy to manage. And so what happens is when we get that tax incentive back, we actually wind up this company, close it down, and then move on to the next one. So at any one time, we could have a number of these SPVs running. At the moment, I think I have 4 live SPVs that we're managing. So when I log into my bank account, I'm seeing bank accounts for this company, and then like 4 SPVs. So you can see how it does become, there is quite a bit to manage here in terms of the back end. And often this is something that you don't really think about when you're starting out, right? You're just thinking about producing films. But there's this whole other administrative back end side to making films. And obviously if you want to build a production company that you're responsible for. So this is how it's all set up at the moment. And hopefully that gives you a really good idea of how we've done it and are doing it. So that's it for now. And so what I want to do over here is show you how I think you could do it in a very just clean and easy way. But of course, make sure that you do get advice on this. So probably the cleanest way to do it is, you have a shareholder. So again, it could be you, it could be a trust, it could be a company. You have a holding co. So the holding company is going to again hold the IP and is going to generate your fees and overheads for the film. And then you're going to set up an SPV for the specific film that you're making. Now, if you run a corporate production company where you're making like commercials and other things, you may want to have another company down here. So if the intention is to keep running your commercial company and then to also have, a number of films that you're producing, feature films or maybe TV or something like that, you may want to keep that IP separate. So you may want it sitting in a holding company separate to your commercial company. At the same time though, you absolutely could have it just in one company. Again, it would be a little bit easier to manage, but that's really why you want to get some advice on the best way to set this up. But what you're looking at here is really the cleanest, easiest way to do it, and the way that I would recommend if you are making a feature film. When I first started, I also kind of, there was at least one film where none of this exists and I just had the SPV. So that was probably the first film that I did. And so there were 3 shareholders, all individuals, and we basically just came together to make the first feature film that we made. And we had everything in the one company, the SPV. And that's also a way that you can do it. It's fine for like a one-off, But I think if your intention is to build a production company longer term, or you want to build a film studio, then setting this structure up from the start, I would say, is a way to do it. It's just easier, because if you do it the other way and all the IP is in this company and you've got different shareholders, and then you want to go and make other films without those people, right? You might have a different team on the next one. It just becomes a bit more difficult to then go back and like change those agreements, or then you might have to move your IP into your new holding company. So it's just a little bit more admin that you'd have to do there. And so that's why maybe setting it up in this way, if your plan is to make films long term, is the way to do it. Or if it's not this way, right, again, make sure you get some advice and work out what the best way is going to be for you to do it to make films over the longer term. Now, let me take you through the 3 mistakes that I learned along the way setting up this structure. The first one was really starting production and distribution at the same time. So in my young 20-year-old idealistic dreamer mind, I thought that I would set up a production company and a distribution company, and they would be vertically integrated like a studio, and I would instantly be able to start financing, producing, and distributing films. Well, I learned very quickly that in order to do that, you need a few things. Number 1, you need time. Number 2, you need capital. And number 3, you need focus. And so the mistake that I made initially was just setting those 2 things up at the same time. If I was going back and starting again today, what I would do is pick one. Could be either of those. I don't think it matters. The important thing is to pick one and then focus on it, grow that for a number of years, and then add the second one, and if that's still something that I wanted to do at that time, into the mix. Because I think when you start both of them at the same time, my experience was you don't know where to put your focus, your time, your energy, your priorities are somewhat split. And so while there were some benefits to having this structure along the way for me, particularly when it came to getting tax incentives in Australia, it was helpful to have a distribution company as well as a production company. In terms of it being, like the best way to run a business, to start a business, grow a business, run a business, make that business sustainable, I don't think it's the best way to do it. And so if I was starting again, I would pick one. The second lesson I learned is that, there are a lot of administrative costs and expenses and time that needs to go into managing all these different companies. So you've got your production company, a distribution company, and then you have companies for each film. And so for example, right now I have, I think 4 active companies that are just films. So not including the production company or the distribution company, 4 other film specific companies. And so each of those companies requires administrative work when it comes to the accounting in particular. Each quarter I have to prepare books and submit them in Australia for something called our BAS, which is basically our sales tax. At the end of the year, there are tax returns. So there's just all this ongoing management involved with each one of those companies. So if I was starting again today, what I would do is make sure that I allocated some money in the budget of the film for those ongoing administrative costs, so that I could at least recoup my time, right? I could get paid for that work, and that it wasn't, these ongoing costs that I was just having to float myself. The third lesson is that I would attach a collection agent to each of these films so that they could manage any revenue that was starting to flow back from those projects. So on the first 4 films that I didn't have a collection agent on board. And so what that means for me now is that at the end of each quarter, I either receive or I have to chase up royalty reports from the different distributors that are releasing the film, and that's distributors in different countries, so not just in my home country. So I have to chase them up, I have to get the reports, then I have to invoice them, then I have to receive the money, and I have to pay that money out to the investors. And so this is all happening in my holding company, Exile Productions. And so that just creates a lot of work for me. And so it's something that if I was starting it again, what I do is make sure that we have a collection agent on each of the films that we're making. That's something that we always do now because it just makes that part of it a lot easier. That's it for this video. If you liked it, hit the like button, subscribe to the channel, drop your comments in the comments section below. If you have any questions about the content of the video, drop them in there and I'll be happy to get back to you. And if you liked this video, make sure you check out this video next.